Hey guys, the SLR is expiring today. It was a supplementary leverage ratio rule that allowed us to look at this ratio, look at how easy it is for an institution that needs money to have that money in a financial crisis, right? These are tier 1 capital that allows you to basically have near liquidity, and this number should be around 5%. It's a minimum requirement, and we have been seeing the temporary rule knock off a couple of the values in the denominator, right? Since the beginning of the pandemic until today, these banks were able to knock off certain pieces like bonds from the denominator. That knocked off trillions of dollars from the ratio here, which made this easier to be above 5 to 6%. However, today that expires and it's going to be part of something much bigger. So if you watch until the end, you'll learn exactly what the everything short is. Throw this source some love, written by user ATOBITT, right? ATOBIT. You guys are going to be able to not only give this post a upvote, but also be able to start learning about how to show this video some love. Drop a like down below and help us grow up to 75,000. We're on our way to 100K subscribers, and we want you to be part of it. Too long, didn't read. Citadel and friends have shorted the treasury bond market to oblivion using the repo market. Citadel owns a company called Palafox Trading and uses them to exclusively short and trade treasury securities. Palafox manages one fund for Citadel, the Citadel Global Fixed Income Master Fund Ltd. Total assets over $123 billion, and 80% are owned by offshore investors in the Cayman Islands. Their reverse repo agreements are entirely hypothecated, and they cannot pay off their own repo agreements until someone pays them first. The entire global financial economy is modeled after that fractional reserve system that is beginning to experience the mother of all margin calls. This is why the DTC and FICC are increasing an increase in SLR deposits. The madness are officially coming full circle. And if this sounds scary, one of the first things that you'll know is arm yourself with data, right? Data is king. That's what we cover on this channel, and I think you're going to make a lot of great movements for your own passive income, for your own financial freedom, if you start joining us down below, either with the subscribe or the join button, and watch until the end. So away we go to understand exactly what is going on here. I'll skip the fluff, go to the most important pieces, and then use Mr. Whiteboard to be able to help us chart out exactly what's the more complicated pieces here. So we have the author of Citadel has no clothes here. They could not shake one major issue. Why do they have a balance sheet full of financial derivatives instead of physical shares? The concept of hedging instrument is to protect against price fluctuations. Hopefully you get it right and make a good prediction, but to have a portfolio with literally 80% derivatives, absolute insanity. It's the complete opposite of what should happen. So what is going on? Let's break it into 4 parts. 1, repurchase and reverse repurchase agreements. 2, the treasury bonds. 3, Palafox trading, and 4, the short seller endgame. We're going to breeze on through and just cover the important pieces here. Step 1, repurchase and reverse repurchase agreements. What are they? They are much like a loan, right? This is a repurchase agreement. If you have a big juicy banana worth $1 million and need some quick cash, a repo agreement might be right for you. Just take that banana to a pawn shop, pawn it for a few days, borrow some cash, buy your banana later, plus a couple of attendees in interest. That creates a liability for you because you have to buy it back unless you want to default and lose your big beautiful banana, right? You can also know it in the financial world as collateral. Regardless, you either buy it back or lose it. A reverse repo is how the pawn shop would account for this transaction. The pawn shop sells a reverse repo and you sell a repo, right? A repurchase agreement is on your side, the reverse repo is on their side. Why does this matter? Well, repos and reverse repos are the lifeblood of financial liquidity. They allow for super fast conversions from securities to cash. The repo agreement I just described is happening daily with hedge funds and commercial banks. In fact, the submitted amount for repo agreements today is 40 billion for one day. This is due on the 30th. So yeah, super short-term loans, usually a few days. It's probably not a surprise that back in 2008, the go-to choice of collateral for repo agreements was mortgage-backed securities. This is giving anyone PTSD because it certainly isn't sounding great. Essentially, if you need money now or very, very soon for a very short amount of time, this is a great way to take whatever you need to whatever you own and then just give it to a pawn shop. But you know, it's not a pawn shop, it is the global economy. So this is a great way to turn into liquidity real fast. The Lehman Brothers went bankrupt because they fraudulently classified repo agreements as sales. You can do this your own research, but they'll give the quick and dirty. All right, here's what Lehman did. Lehman would go to a bank and ask for cash. The bank would then ask for collateral in return, and Lehman would offer mortgage-backed securities. It was great having so many mortgages on your balance sheet, but what good does it do if you have to wait 30 years for the cash? So Lehman gave their collateral to the bank and recorded these loans as sales instead of payables, with no intention of buying them back. This extremely overstated their revenue. When the market started realizing how bad these AAA securities actually were, thanks to Michael Burr and friends, they were no longer accepted as collateral for repo loans. We all know what happened next. Now you basically have the entire the big short summarized right there in this paragraph. The interest rate in 2008 on repos started climbing as the cost of borrowing money went through the roof. This happens because the collateral is no longer attractive compared to cash. The favorite bedtime story is how the Fed stepped in and bought all of the mean toxic assets to save the US economy. They literally paid Fannie and Freddie over $190 billion in bailouts. So here's the US repo rate. Right, we can see just a couple of outliers, hint, hint, back in 2019, and then today. So the repo rate jumped to levels reminiscent of the depth of the financial crisis before retreating. A few years later, the MF Global would suffer the same fate when their European repo exposure triggered a massive margin call. Right, we've talked about margin calls before. It's when you owe either shares or money or something, and you don't have the ability to ever pay it back. When you get closer and closer, you risk getting margin called. Their foreign exposure to repo agreements was nearly 4.5x their total equity. Both Lehman and MF Global found themselves in major liquidity conundrum and were forced into bankruptcy. Not to mention the other losses that were incurred by other financial institutions. Check this list for bailout totals, right? We'll have that link once again down below. But did you know this happened again in 2019? Right, that's what that spike we saw earlier in that chart above in 2019, the US overnight repo rate. Once again, these are repurchase agreements. Instead of the gradual increase in rates, the whole thing spiked to 10% overnight. This little blip almost ruined the whole show. It's a huge red flag because it shows just how the system must remain in tight control. One slip and it's game over. The reason for the catalyst was once again due to the lack of liquidity. The Federal Reserve stated there were two main catalysts, both of which removed the necessary funds that would have fueled the repo market the following day. Basically, their checking account was empty and their utility bill bounced. It became apparent that another infusion of cash was necessary to prevent the whole thing from collapsing. Reason being, institutions did not have enough excess liquidity on hand. Financial institutions needed a fast replacement for the MBS, and Jay Powell had just the right thing. Fed go brr. We've heard about Jay Powell talking about making that cash printer go, but don't say it's QE. The one thing about Jay Powell to understand is that he controls the US printing machine for cash, right? So this is one of the things that he did back then, and something that we were wondering if he was going to do during that press conference that we covered live, and we will continue to cover his actions as we go along. So that's step one. Now that you guys understand repos, right? If you don't, drops a question in the comment section, right? And let's see the hive mind come and grab it together. Let's see. So we have ever heard of the bond market? Well, it's the red-headed stepbrother of the stonk market. The US government sells you a treasury bond for $1,000 and promises you to pay you interest depending on how long you hold it. Might be 1%. Might be 3%, might be 10 years, might be 3 months, might be 10 years. Regardless, the point is that just purchasing the US Treasury bond in conjunction with mortgage-backed securities allowed the Fed to keep pumping unlimited liquid tendies into the repo market. Surely liquidity won't be an issue anymore, right? Now take the repo scenario from the Lehman Brothers story, but instead of using only mortgage-backed securities, add in the US Treasury bond, primarily the 10-year. Note that the MBS are still prevalent at 19.1% of all repo transactions, but the US Treasury bond now represents a whopping 67%. Boom. Let's take a look at this. There's a sheer amount of difference here, right? So average daily outstanding repo, right? And the collateral for repo here. Overnight term is these two pies here. I honestly cringe as a data scientist whenever I see pie charts. However, this gets the point across, right? We had the repo scenario from the Lehman Brothers story. Instead of mortgage-backed securities, we are looking at treasury bonds, right? This is the same story with a different asset. Step 3. Okay, so that was an easy step. Ever heard of Palafox trading? Me neither. But it's pretty much meant to be that way. You see, Palafox trading is a market maker for repurchase agreements. Initially, they appeared to be an innocent trading company, but their financial statements revealed a little secret. GameStop is bouncing off of that 187 level of support. Essentially, what I said, if the VWAP was not contested again, we were likely going to see this sideways trading here. And luckily, we were caught at 180, and we are going to continue grinding along. 187. Palafox Trading is a market maker for repurchase agreements. Initially, they appeared to be an innocent trading company, but their financial statements revealed a little secret here in the highlighted section. Citadel Advisors LLC is responsible for managing all investment and other activities for the company. Citadel Enterprise Americas LLC and Citadel Americas LLC, both affiliates, provide administrative and investment-related services to the company. And who is the one with the GoFundMe and the $600 million in bonds? The GoFundMe is a joke, of course, but it's pretty close. I should have known. Of course, Citadel has their own private repo market. Who else is in this cesspool? Citadel Global Fixed Income Master Fund, GFIL, is the sole member of the company. All right, so here is a cool little charting system here. We have how Citadel Advisors pushes securities and cash through Palafox trading here. So Citadel Advisors is pushing, advising the Palafox traders here. And we have the Palafox working with Citadel Global Fixed Income Master Fund, right? Still a Citadel subsidiary working with the sister arms of Citadel here. Citadel Wellington, Citadel Kensington, Citadel Kensington Global, Citadel Global Fixed Income Fund, LLC and Limited, and then they work with offshore holdings here between the Citadel Global Fixed and the Kensingtons, and then finally these are the shareholders and beneficiaries of GFIL. That doesn't make sense. We're going to cover in just a second here. Everything rolls into the Citadel Global Fixed Income Master Fund. This controls I'm going to count this right now, $123 billion in assets under management. I know offshore accounts are technically legal for hedge funds, but when you look at the itemized holdings of these funds on Citadel's most recent form, gives you chills. On the ADV, it says $123 billion in current gross assets of the private fund. Wow. Okay, let me get this straight. Let's see. The repo market provides immediate liquidity to hedge funds and other financial institutions. Wait one sec. The repo market provides immediate liquidity and hedge funds to other financial institutions. After the MBS collapsed in 2008, the U.S. Treasury replaced it as a liquid asset of choice. Number 3, Citadel owns 100% of Palafox Trading, which is a market maker for repo agreements. Number 4, this market maker provides liquidity to the Global Fixed Income Master Fund, GFIL, through Citadel Advisors. And number 5, 80% of the $123 billion in assets under management belong to the entities in the Cayman Islands. Wow. So once again, repos are allowed to give them straight up cash when this is basically a shell corporation that allows them to make repo agreements. The market maker provides liquidity to GPhil through Citadel advisors, and now $123 billion in assets are under management by a shell company from the Cayman Islands. They just tore Bermuda, Paradise, and Panama Papers apart and found that all of these funds boil down to just a few managers, but they can't pin anything on them for money laundering. However, if there ever were a case for it, they'd be incredibly suspicious of this one. The level of shade on this is incredible. There should be no room for an investment pool as big as Citadel to hide. Absolutely ridiculous. The fact that there's so much foreign influence over the bond and repo market, which controls the liquidity of the country, is very concerning. And once again, they said this back in 08 too. The fact that there was just so much corruption in the mortgage-backed securities was also very alarming. I believe Allison Christensen is asking for my data science guides. They are in Discord, and you have access thanks to the power of Patreon and the power of the YouTube API. So both of which would be able to get you those data science guides, the 66-day guide, which is in the private Moon Platoon, private Discord, and the 21-day guide, which is in the private, oh no, the Mo Monkey is the one that has 66-day guide. The 21-day guide and the 66-day guide are both in the Moon Platoon private Discord. So Allison, go find it there. Step 4. All right, I know this is a lot to take in. I've been writing this post for a week, so reading it all at one time is probably going to make your head explode. But now we can finally start putting all of this together. Okay, remember how I explained that the repo rate started to rise in 08 because the collateral was no longer attractive compared to cash? That means that there wasn't enough liquidity in the system. Well, this time the opposite effect is happening. Ever since March 2020, the short-term lending rate, repo rate, has dropped to 0%. So the Fed is printing, hold on, let me show you can read this here. The Fed is printing free money, the repo market is lending free money, and there's basically no difference between the collateral that's being lent and the cash that's being received. With all this free money going around, it's no wonder why the price of the 10-year treasury has been declining. So essentially, this is how much it costs to lend out these repurchase agreements, right? And they have essentially dropped to almost nothing. So you can just pass around these repurchase agreements like candy, popped from the take a penny, leave a penny tray. In fact, hedge funds are so confident that the 10-year treasury will continue to decline that they've shorted the 10-year bond market. Not talking about speculative shorting, I mean shorting to oblivion like they've shorted stocks. Don't believe me? Hedge funds like Citadel advisors must first locate the treasury bond in order to swap them for cash in the repo market. It's extremely difficult to do this with the Fed because they're tied up in the government poopy. So they have to locate a lender in the market. Now, who would Citadel know that's an asset manager? Perhaps the same asset manager that they borrow shares from, BlackRock. Oh, back to BlackRock Bag Holders Inc. It's now obvious that BlackRock was tapped by the US government to purchase their treasuries. Federal Reserve taps BlackRock to purchase bonds for the government. So BlackRock purchased a ton of treasuries and keeps them in reserve for hedgies like Citadel to short. Citadel comes along and asks for the bond. They throw it to the Palafox trading and collect their cash. So what happens when they need to pay for their repo agreement? Surely to God, there are more bonds floating around, right? Not unless hedge funds like Citadel have shorted more bonds than there are available. Oh man. So they have also over shorted bonds. This is either recursive shorting or naked shorting. Let's find out. There have been 3 instances over the past year where the repo rate dipped below the failure rate of -3%. On March 4th, 2021, the repo rate hit -4.25%, which means that the investors were willing to pay someone 4.25% interest to lend their own money in exchange for a 10-year treasury bond. This is a major signal of a squeeze in the treasury market. It's a major desperation to find bonds, with the Federal Reserve purchasing them monthly from the open market. It leaves room for a shortage when the repo call hits. If an entity like BlackRock hasn't purchased more treasuries since lending them out, hedge funds like Citadel simply cannot cover unless they go into the market and pay the bondholder for their bond. This literally has the same story as the heavily shorted stocks. It's essentially the exact same 2008 crisis revealed in this DD, but with repos instead of mortgage-backed securities. Now, still not convinced, in the end of 2020, Palafox Trading listed $31 billion in gross repo agreements. $30 billion were traded directly related to the repurchasing of treasury bonds. Wow, now this is the most important piece of the story, honestly. What about the reverse repurchase agreements? Don't they have to assets to buy treasury bonds? Sure, take a look. So they have gross amounts of $31 billion of reverse repurchase agreements here. See there, they had it covered. Now read the fine print. Let's get our glasses on. Typically, the company has, Typically, the company has rights of rehypothecation with respect to the securities collateral received under reverse repurchase agreements. As of December 31st, 2020, substantially all securities collateral received under reverse repurchase agreements has been delivered or repledged in connection with repurchase agreements. So, no, they don't have it covered. Why? Because our terrible financial system allows for rehypothecation. That's why. It's a big fancy word for using amounts owed to you as collateral for another transaction. In the event that the party defaults, so do you. This means that the securities which Palafox is waiting to receive have already been pledged to pay off the bonds they currently owe to someone else. Oh, does this sound familiar? Promising to repay something with something you don't already have. Basically, you have to wait on Ted to repay Steve, to repay Jan, to repay Mark, to repay you, and so you can repay Fred, and so Fred can, real secure. So this problem is getting worse, right? This number is increasing since 2018, 2019, and in 2020, still 100% greater than 2019 after netting. All of this is making me wonder if the FICC's balance for the Treasury deposits. For those who don't know, FICC is a branch of the DTCC that deals with government securities. Just like the updated DTC rule for supplemental liquidity deposits being calculated throughout the day, FICC also calculates this amount as it relates to the Treasury securities multiple times throughout the day. Can you imagine how astronomical the actual margin must be? Holy moly, there's too much evidence from too many separate events pointing to the imminent default of something big. That's all this is going to take. When Ted can't repay Steve, it means the panic has already started. Just look how easy it was for the repo rate to spike overnight in 2019. We're already starting to see the consequences of the SLR update with Archegos, Nomura, and Credit Suisse. We covered them earlier 2 days ago. This is just a taste of what's to come. And now we have the bond markets represent an even bigger catalyst in triggering this event, and it's happening already. With that said, things are starting to make sense. Citadel doesn't need shares if their investment strategy is to go short on everything instead of going long. Why bother owning shares? BlackRock and other asset managers simply lend them to you when you need to pony up a margin call for stocks and bonds. Their HFT systems allow them to manipulate the market in their favor, so there's no way they could fail unless a bunch of degenerates all decided to ignore taking profits. But that could never happen, right? Wrong. We just like the stonks. This is not financial advice. As a reminder, this is essentially the omen right before the SLR requirements are once again exposed to a higher minimum, right? Because we have knocked out the bottom part of this denominator, this now needs to be bigger here. And as we've known, they could use this system to get more cash in a quick way, right? If they need liquidity, they could use these repos, the repurchase agreements, in order to be able to do that. However, right now we are seeing major manipulation and corruption in that system. And it's not like this is a conspiracy. This happened in 2008. This happened in 2008 and is likely going to happen again. We're going to give you guys live, up-to-date updates on this news story because we are live for 7 hours each day, bell to bell, and I'm looking forward to seeing you in a future live stream. Smash that like button for other Space Apes Moon Platoon members to find out about this story, and subscribe so we can get all the way up to 100K. We're on the journey to 100,000 subscribers, and we would love to have you aboard. Let's thank the people that have not only pressed that sub button, but also pressed that join button, the Moon Platoon, Meatball, the Space Legend, and the Gorillionaire tiers, and we will see you in the money.